From early December through mid-March, the historic correlation between gold and the Australian dollar has stayed fairly consistent. Over the last week, though, things have changed as gold has rallied 3.5% off its April 6 low, and the Aussie dollar against the US dollar had lost over 2.5% in the same time period. It appears to some that the main factor pushing the Aussie dollar down is growing expectations for a hawkish Fed, and that has been propping up the US dollar against all currencies. Gold is also benefiting from a global demand for the entire commodity complex as investors look for hedges against worsening inflation. Whatever the reason, it's notable that these two assets moving in opposite directions for extended periods is somewhat rare. If a trader believes that the correlation will resume and that the Aussie dollar will begin to follow gold higher, they could express that by buying the CME June micro Australian dollar futures contract at 0.7450 and target the April 6 high of 0.7600. And a stop for this trade could be placed below at 0.7375. This trade would make $150 if your target is reached and risks $125 if you're stopped out at your level. Traders have three different contracts to trade the Aussie dollar: the standard, the mini, and the micro. And it all makes it a lot easier to match a trader with their specific risk tolerance. For this example, we're using the micro. Now, if a trader believes that the move in Aussie has legs and it will continue lower, perhaps pricing in more Fed hawkishness, they could sell the CME June micro Aussie dollar futures contract at 0.7450, the current level, and target the mid-March lows of 0.7200. A stop for this trade could be placed above at 0.7590. This trade could make $250 if your target is reached and risks $140 if you're stopped out at your level.